Good morning, Jason. Nice to see you.
Morning, Captain. Thank you for having me back.
All right, you been training?
Not so much with the running.
Hesitated.
Not so much with the running, but rugby, cricket, getting involved in all sports around the island. So
the heat doesn't bother you, does it?
It does a little bit. I'm still getting used to the humidity.
All right.
The heat's okay, but the humidity is tough.
All right. Our topic today is we're going to talk a little bit about diversification and all that.
Yes, definitely. That's a word that you're going to hear me say very often, and you should hear.
Should know what these terms mean, really.
Well, definitely, it goes down to that good old saying: "Don't keep all your eggs in one basket." Right. And that may seem like a simple saying, but it's something that you really need to take into consideration and just ensure that that's the way that you're going to mitigate your risk in the market.
All right.
I have a lot of people that come to me and they're like, Jason, I like X, Y, and Z, or I want to buy 2 or 3 or 4 stocks, and this is what I like, and then I have to sort of push them in a little bit of a direction to say like that's great.
Guidance. I mean, you know what you're talking about. They don't know. I mean, a lot of people, I guess, deal from what I like, their passions, and a little bit of knowledge they might have. So, but they don't want to get carried away with that. That's why you experts at LOM come in, right?
Yes, and then the often what we get is, my friend told me, or I've heard this, and
advice from somebody.
Well, the thing is, it might be, something that somebody just said in passing, and now you've taken it maybe to heart, and then coming in with this expectation, and then when we sit down and have a bit more of a deeper dive into things, it's a different to what they expected when they originally sat down with me.
So you're talking diversification. So a lot of people might come in and think, I'm going to just drop this money right here, and it's probably going to be on one subject thing. But you want them to spread it out a little bit.
So yes, think of it this way. If you had to purchase just one stock, and let's take Apple for an example, and this is not I'm definitely not giving advice to buy Apple. It's a well-renowned example stock. So if you had to take all the money that you're looking to invest and put it on one stock, now suddenly whatever that stock does is how your portfolio is going to perform. So yes, you could get it right. You could get the 1 in 1,000 where you buy Apple, and yes, it goes up 25% for that year, and you're smiling, and you sit there and think, wow, I really know what I'm doing. But the unfortunate thing is, let's say Apple now brings out a new phone towards the end of the year, and maybe it's not so successful. It usually is, but maybe it's not this year, and suddenly in a day you lose 10 or 20% due to the public view on that stock. So when you either diversify by buying multiple products, or there are simple ways where you can buy a product, or when I say buy, I invest in a product that has multiple underlying assets, that is actually diversification through one product, and we may get into that a bit later. For example, a mutual fund, there's diversification in keeping it simple and investing in one product.
All right. So, coming to your office, what do we do? Make an appointment with you and all that?
Yes, you can just reach out. You can either call in, get us through our website. That's the easiest way, allocation.com. There's a contact function through there. You can ask for Jason. Alternatively, our number is 292-5000. That's 292-5000. Call in, ask for Jason. We'll set up a consultation. It's non-obligation. It's totally free. Come in, we have a chat. We see where you are, how we can help you, and we take it from there. See how we can work together.
So here I go. I'm going to ask you. I'm going to throw some things at you to determine my risk factor or my tolerance for the markets and all the other stuff. What does age have to do with all this?
All right. Well, look, you are an older gentleman, not an old gentleman. Yeah, older gentleman. So you must understand, you don't have as much time as, say, a 25-year-old has.
Right.
So you got to take that into consideration, that your risk is a bit higher. So you don't want to take high risk because you don't have the time. Too. That's the thing. You've got a shorter term, so you don't have that time in the market that maybe you need when going with higher risk options.
All right. So because of my age, would I have to invest more to get more back in a shorter period of time?
Well,
would that work or not?
That would work, but you want to be more conservative because let's say, there is for example, what happened last year in the markets where it wasn't so great, it may take some time for that to recover.
Sure.
And if you don't have that time and you're reliant on those funds that you're investing, because that's another point that we look at for to look at your risk tolerance is your financial situation. So if you're reliant on that investment funds that maybe you need a monthly income from that, or you need to continuously draw from that to actually live, then we can't be going high risk where that could be very volatile and suddenly you lose 10 or 15% in a short space of time.
Well, that word is very important, volatile, as in the market being rocky or rough or whatever like that. So you got to consider that. It's a whole new language in the financial world. I want you to know that, Jason.
No, it's unfortunately the market can be volatile, and that's where you try to diversify to mitigate that risk and ensure that you've got all corners covered.
All right. Now, young people that, like you say, have the time. Older people, maybe mid 50s to their 60s. Retirement factor is a big deal, and I think a lot of people are looking to retire, and if they want to, is investing a good way to go about it. In other words, again, not putting all your eggs in one basket, but you never know how much you're going to need when you retire. You never know if illness will strike when you're older and all that. And
there's ways to look at that and decide kind of how much you do need or how much is enough, what sort of your lifestyle is, what are you currently spending. So there are ways to kind of estimate. You wouldn't know to the cent, but
general area.
Yes, no, you could give an estimation and work towards a goal. But we always say it's never too early to invest and it's never too late to start investing. So when a younger person comes in, say a 25-year-old,
they got goals.
They've got lots of time though.
Yeah, they've also got goals. They want to be at a certain place at a certain time.
Correct.
I always smile at you investors, at you your financial people. You say, look, had you when you were 21 saved this amount, by the time you were 30, you'd been a millionaire. Exactly. You heard that one all the time.
I think last time I was on, we spoke about exactly that. Yeah. The difference between investing over 10 years and 20 years and 30 years. Yeah. And it's just such a complete difference and it's a much smaller amount over a longer period of time to, for example, get to $1 million. But, going back to what you said, with the age, an older person, there are options to still invest. Mm-hmm. There's more conservative options, maybe more straightforward, depending on what the goal of that person is, because everybody's situation is different. There's no one size fits all, because a certain person that's coming to retirement may need those funds, and then we come up with a certain plan for them to be able to use the funds as needed and live off them.
Keep the security of those funds.
Exactly. Yeah. But another person may go, right, this is actually just an investment that I have that I may never touch. I may just pass on to the next generation or to my grandkids, or to, it may be for a specific, it could be to go to charity, it could be for anything, depending on what that person's goal is.
Do you ever have couples come in, as husband and wife, and they want to invest together, or do you have a situation like that? Or?
Yes, I mean it's usually like that. Yeah. I think most couples they will be open with each other about their finances, so they often want to come in and do a joint account. We do that. We do not a family account in terms of one account, but you can have accounts for your children. You can have accounts for your spouses. You can have separate accounts.
Portfolio. You just have like a.
You can have a spread across the family if that's what you're looking for, with different goals, different time horizons, and that's when you'll look at the different goals that you have for each of those accounts, maybe.
Right. Can we talk about asset allocation?
Yes, so we can look. The asset allocation is kind of the way that your portfolio is split. Mm-hmm. So at different ages, you will look to have different asset allocation. So when you're 25. You've got lots of time in the market. You have 30 plus years.
Less risk.
so there's less risk, because we always speak about time in the market, not time in the market. Mm-hmm. So as a 25-year-old, you'll have lots of time to take a lot more risk, and that's when you'll be more heavily invested in, say, equities, which can be more volatile. When you get to sort of let's say mid-30s, now you're married or getting married or looking to purchase a property, things like that, exactly. And now you might have maybe 2 or 3 goals that you have to do, and you have to sort of change the game plan on, all right, let's take a little bit out of equity and put something into more short-term plan for purchasing that property or something like that, wherever the goal is. Okay. Then when you get to the next sort of age, at like 45, maybe you have children that you're sending to college or university, education, other things like that, helping them start with their life. Then you may need to change the exposure again, change the asset allocation and be more conservative. And especially once you get to retirement age, now you don't want to be so heavily invested in equities that may be volatile and more risky. So
something steady.
You will then pull over to maybe to more fixed income or bonds or money market, something that's less volatile.
I want to talk about like mutual funds, and always hear about people say, "Oh, I'm investing in utilities, I'm investing in hospitals, and whatever's hot, during that time." Right now, I suppose in the air conditioning business, good business right about now, right?
Definitely. In
summer. Health is really another one. I'm not asking you to recommend stock to anybody listening to us right now, but I want to talk about that. Mutual funds, what is that exactly?
So mutual fund is, in simple terms, it's a pooled investment. So if you take your clients that have a similar goal or a similar need, that you pool those funds together. You have a fund manager who manages those funds, and through that strategic goal that you're looking to do, so each mutual fund can be different, he changes the allocations and basically aligns those funds as to the goal of that mutual fund. So
what are mutual funds? I mean, what am I investing in with mutual funds?
It can be anything depending on the goal of that mutual fund. So if there's a mutual fund that has, let's say, it's more focused on being like a money market.
Okay.
So that would be very short-term bonds that is very low risk, less volatility. But you could have a mutual fund that's like an equity growth fund that is in the large cap blue chip stocks that maybe is more volatile, more aggressive. But the beauty about a mutual fund is by simply investing in one product, essentially, you can have exposure to all the underlying assets. So there may be 30, 40, 50 different underlying assets. So that's different stocks under that product. Yeah. And that's another beauty about it, because it's managed by the fund manager. He will do all the change in allocations as the market sort of changes, and maybe a different approach needs to be taken. He does all of that, and then you don't need to sit and watch it every day and be worried about, should I change this, should I change that, because that's what the fund manager does.
People always talk about blue chip stocks, which something like Coca-Cola, Apple, all these big companies and all that. You might want them, but they're very expensive to buy, aren't they?
Well, some of them are. Some of them you may believe that they're underpriced currently.
Like, I'd like to buy into Man United, Manchester United stock.
There's nothing wrong. I'm also a United fan.
Hey, don't know what's going to happen until they tell it. Hey, we don't know. I'm just saying. I'm making a joke about that, but seriously though.
No, well, that's the thing. I think maybe a better example we can, that may be more relevant now is like the AI or the tech stocks. Yeah. So that's the way that it looks like the future is going. So yes, those stocks
that's going to grow.
Have grown, and they seem expensive now, but it doesn't mean they're not going to continue to grow. Because where are we heading? Like, for example, a Tesla. Mm-hmm. There's a big push to move to electric vehicles. So yes, we may look at it now and say, okay, it's an expensive stock, but when you look at it again in 5 years, what do you think the price is going to be then?
It's going to be very expensive.
So that's a way to look at it. And again, that's not a stock recommendation.
No.
It's just an example.
Well, we have to do that because people in Bermuda have to kind of gauge what's out there. We're not recommending any of these names, but they're in the market, these names, and so we're just talking about them as an example. But being over in Bermuda and not being in a big market like Wall Street or London or something like that, we're still pretty financial as well here in Bermuda, I know, but a lot of people may feel that they're distant.
Yes, but it's a simple way. Through a firm like us, that's where you can get exposure to the market like in the US and, easy access to that, and we'll provide that platform for you.
All right, look, I've not got a lot of time, but I want to throw this one in there. How do folks get started, Jason?
Again, simply just reach out to us on our website, LOM.com, or reach out via our direct line. That's 292-5000. It's 292-5000. Ask for Jason. Just use the contact function on the website. Reach out. We'll arrange a consultation. Again, no obligation, absolutely free. Sit with us. We have a chat, discuss your financial situation, and see how we help you.
Go for it. Get started. That's the main thing. Particularly if you're young, it's a way to go, really. All right, so again, their website, LOM.com, or you can call Jason at 292-5000 and ask for him. He'll personally take care of you. Good to see you.
Good to see you again. Thank you.
All right.